Okay, so here we are. Let's just get right to it. Basically, I'm going to walk you through on the whiteboard because it's going to be a lot easier for us to go actually through the whiteboard to figure out kind of what math works out best and what is going to be the best sort of return on investment. Now, we're going to use a large sum of money here. And the reason why we're going to do this is because we have to for this particular example. You can put $40,000 into an IRA immediately. However, you can do so over time. So for illustration purposes, we're going to kind of compare what it would be like to have $40,000, let's say in an IRA or 401k. And then to put $40,000 into another vehicle or investment using leverage to see exactly what that looks like. So without further ado, let's go to the board and let's see which one works out better. Now, again, we're going to start off here, assuming you're going to put money into an IRA or 401k. It doesn't really matter. Let's say you had $40,000 in that particular account. Okay. Now, if you go to, let's say you buy an S&P index fund, VOO, for example, regardless, the last 2 years have been absolutely amazing. You're going to see a return on investment of about 8 to 10%. We're going to go with the conservative end here. We're going to use 8% for both of the examples. We're going to go to the conservative side of it just because it's a little bit easier. Again, the percentage, it doesn't matter. You could put in 3%, 5%, 10%. It doesn't matter. Don't worry about that. It's not about the percentages. It's about using the leverage. So let's say we were putting 8% in on $40,000. That's going to give us, if I just run the math here, $40,000 times 0.08, whoops, messed that up. $40,000 times 0.08 equals $3,200 is what we're going to earn in interest that first year. Okay. Now, real short lesson on compounded interest. For those of you who don't know what compounded interest is, basically what that means is if the first year we make $3,200, the second year we're starting off with both a principal and also the money we made in interest. So in the second year, we're going to have $43,000 and $200, and then of course we would take 8% of that because in the second year we did 8% off the larger amount, and then we add that interest to the next one, and so forth and so forth. So what we're looking for here, the important part is that we made $3,200 off of our $40,000. Now, assuming, let's say we wanted to go do something that had or utilize leverage. Now, what leverage is, for those of you who've never heard that term, basically just means that you got financing for something. You used a little bit of your money plus your good credit score to get your hold of something larger. And usually when you do that, while you can leverage in the stock market, that's a completely different video. We're going to say that you use your leverage to go purchase something of larger value. In this case, it would be real estate, which is a very easy one. So let's go over here. We're going to put in our real estate example using leverage. Okay. And now for real estate, let's say you wanted to purchase a property that was, $160,000. $160,000. And the reason why I'm going to put 25% is because when you're buying real estate, in most cases, you're going to get a real estate investment loan. And as it stands right now, most lenders require 25% down. It just happens to be 25% down of $165,000. We won't run the math for you, but it equals $40,000. Okay? So now for the $40,000, so basically what I've done is I've taken the $40,000, instead of putting it into an IRA and letting the stock just continue to grow and getting that 8% return year over year and having that account build, I've decided to take the same $40,000 and go to the bank, get a loan, get my hand on $160,000. I took that $160,000 and then I went and I purchased a property. Okay, so hopefully that makes sense to you. And if I'm talking to you and it sounds like I'm talking to you kind of like you're an infant or an elementary school, that's what I'm trying to do, is break this down as easy as possible. I understand this is easy concepts for a lot of people, or some people isn't, so we're trying to keep it very simple here, okay? So the way you make money off real estate, a lot of people realize this already, but you have a certain amount of expense for that particular property. That would be the mortgage itself, the one you just took out. You have taxes, you have insurance, you have something called vacancy, you have CapEx, which basically is, as things go wrong, you got to replace things and so forth. But let's just say all in, you've been renting this thing out, and you know that your monthly expense is $1,000 a month all in. Well, you're renting this property out. Let's say you're renting it out for, I don't know, $1,300 a month, right? So if your expenses are $1,000 and you're renting it out to a family for $1,300, your profit there is $300 a month. So you take that $300 a month and you multiply that by 12, and what do you have? Was $3,600. So in this particular case, what we're going to do is we're going to go in and we're going to put our $3,600, assuming this is the cash flow from the rental property. You know, just to help you guys out, I'm going to put rental income. Okay? So here's the point. Okay? Now this, if you're looking at this board right now, you might be staying back and going, and this is actually pretty good numbers for, you know, about what you get. Believe it or not, and this is a side, but when we invest in real estate, we're looking for about an 8 to 10% return, and we usually get about an 8 to 10% return cash on cash off of our money. If I put money in the stock market in an S&P index fund, I'm going to be looking for about an 8 to 10%. We're going to keep this video short, but in the nutshell, if I was going to make more money off the stock market, I would put money in the stock market. If I made more money off rentals, I would put more money into the rentals. So just the market has a way is sort of figuring in that the investment you get generally for money putting into an investment is about 8 to 10%. Believe it or not, I own a restaurant. The restaurant gets about 8 to 10%. It's all about the same. That's a different video. So the point is, though, if you're looking at this and you're like, well, it looks like it pretty much is the same number, but on the other side I have a mortgage, you would be right. And I got it. Again, don't get hung up on the fact that the stocks could be higher, the rental income could be higher, and you could have got a better deal and all that kind of stuff. We're using this as an example of leverage. The point is if you had $40,000 and you had an 8% return off of that, you would make about $3,200. If you put $40,000 in real estate, you're going to get about an 8% return cash on cash, just like you would in the IRA, and that's going to yield you about $3,200. In this case, it's just an example, $3,600, because that's what we use. In both examples, you're getting an 8% return. This is how real estate works. It works very similar to the stock market, very similar to even restaurants. Okay, they're all about the same. The major difference in this is what you didn't necessarily see is the power of the leverage. Now you might be looking and going, well, but where is that? I don't see that. The point is that when you're increasing in value in your IRA, the $40,000 represents your ownership of a bunch of stocks or companies. And those companies are going up in value, and then stocks going up in value, and that's where you're getting the return on investment. On the cash flow side of things, on real estate, the cash flow that you're receiving doesn't necessarily represent the increase in the property value. Instead, it's a product of the machine that it is, or the investment itself, meaning I bought a building and that building's producing something. It's an asset that's actually producing me some kind of income. So one thing we need to consider is what is the appreciation of the actual asset? And that's what a lot of people miss, and that's the power of leverage. So if I take this $160,000, remember we purchased this house for $160,000. Just like everything else, real estate goes up generally every single year. Now you can put in Google and you can figure it out. In the last couple of years, the real estate's been up to 20-30%. That's not normal. We've had in 2008, the market has crashed. Generally, you're going to see like a 3 to 5% increase in value of your property over the course of owning it, right? So let's do the math here. Let's take 160,000, okay, times 0.05. We're going to take 5% increase. That is an $8,000 increase in value. Okay, so let's add that. Now, in an effort to keep this video short, we're going to cut it off here, but I bet you can actually already tell from what I put on there where the value comes from. The difference is that when you take your little bit of money and you leverage that to get a larger sum of money, even though you're going to have to borrow that larger sum of money, when you get a nice return, even if it's at a 3%, do the numbers at 3% on this, even if it's at 5% or 8% or 30% like it is, there's a tremendous amount of value because you're getting 3 or 5% off of $160,000 versus 3 to 5% off of just the original amount that you had. In this case would be the $40,000. So it works on any number of ways. If I bought an apartment complex and it was $3 million, the numbers get even larger. If I was using a $6,000 investment to put into an IRA, I did a $6,000 into a property as a down payment, it'd be a pretty small, ugly property, but you get potential. It works the exact same way. When you put money into real estate, you make money off of the appreciation of the property, the cash flow of the property. Of course, you're going to get the mortgage pay down of it, and then there's some tax benefit. We're not going to go over all 4 of those. We have another video that you can watch for that, but I just wanted to show you how using leverage can maximize your ability to accumulate massive generational wealth. Now, this property gained $8,000 in a year because it went up 3 to 5%. So let's just say we kept that property for, 10 years. You're talking about an additional $80,000, let's say times 10, because you're going to get that for every year. This is $80,000 that you would actually receive from just simply, not the cash flow, but simply the appreciation of that particular property. What is that $80,000? Well, I don't know if you paid attention, but we put down $40,000 in the property to get the property at $160,000. That is almost, ladies and gentlemen, almost like another 2 properties. So what a lot of real estate investors do is they put money into a property, they wait for that thing to appreciate, they use the leverage that appreciates. Now once they have a nice amount of equity in the property, in this case an additional $80,000, they're going to pull out that $80,000, right, of their property, basically getting their entire $40,000 back. And they're going to use that $80,000 to then go leverage and purchase another property or to go into some other investment, and they're going to kind of pay it forward. At the same time, they're still going to get the cash flow from the original investment, from the original property, and that original property is still going to appreciate. So hopefully this is just, kind of opens up your mind a little bit. There is a lot more information. This can get very, very complicated very, very quickly. We have very detailed lessons about how this all works. This specifically just wanted to show you how the potential of leverage can really maximize your ability to build just, again, massive generational wealth. Hopefully you got a little bit of value in this video. If you did, we appreciate a thumbs up. Of course, like, share. If you have a question about this, comment below. What would you rather do? Do you think you should be doing the 401k, or are you okay with doing a little leverage, taking on the higher risk to get the higher return? I'd love to know. And have you done this before? And if you have, I'd love you to share with the group so they can kind of see, you build that confidence. Your ability to be successful is generally who you surround yourself with. Join this community. Comment below, let other people in the community, what you're doing, give them the confidence to pull forward. We always say, once you've made it and you've created that massive generational wealth, the best thing for you is reach back, pull forward the person behind you so that they can benefit from your expertise and your experience.